So, good morning, students. Myself, Dr. Lakshmi Pataya MG, Associate Professor of Commerce, Government First Grade College, Koratagere. My title is Financial Accounting. So, I am discussing the session number 6. What is the topic? Theoretical framework of accounting. International Financial Reporting Standards, that is IFRS. We know the introduction, meaning, objectives, importance, and functions of IFRS. So, introduction to IFRS. International Financial Reporting Standards, IFRS, are a set of globally accepted accounting principles. International Financial Reporting Standards are a set of globally accepted accounting principles and standards developed by the IASB, that is International Accounting Standard Board. These standards are designed to bring consistency, transparency, and comparability to financial statements of companies across different countries. So IFRS are set of accounting standards that govern how particular types of transactions and events should be reported to financial statements. They were developed and re-maintained by the International Accounting Standard Board. The IASB objective is that standards to be applied on global consistent basis to provide investors and other users of financial statements with the ability to compare the financial performance of publicly listed company on like for like basis with their international peers. So IFRS are now used by more than 100 countries, including the European Union, and by more than 2/3 of G20. IFRS sometimes confused with International Accounting Standards, which are older standards that IFRS replaced in 2000. So IFRS provides a common accounting language that helps business, investors, regulators, and other stakeholders to understand and compare financial statements internationally. With globalization and cross-border investments on the rise, IFRS has become essential for ensuring high quality and uniform financial reporting. So, what is IFRS? IFRS are a set of accounting rules for the financial statements of public companies that are intended to make them consistent, transparent, and easily comparable around the world. So IFRS stands for International Financial Reporting Standards. These are a set of globally accepted accounting standards developed by the International Accounting Standards Board. IFRS provides a common accounting language so that financial statements can be understood and compared across international boundaries. So it is designed to bring transparency, accountability, and efficiency to financial markets around the world by standardizing the way companies report their financial performance and position. So IFRS are a set of accounting rules for financial statements of public companies that are intended to make them consistent, transparent, and easily comparable around the world. So IFRS currently has complete profiles for 168 jurisdictions, including those in the European Union. The IFRS is issued by the International Accounting Standards Board. The IFRS system is sometimes confused with the International Accounting Standards, which are older standards that IFRS replaced in 2001. So, what are the objectives of IFRS? The first one is uniformity in financial reporting. To provide a common accounting framework across different countries, making financial statements comparable globally. The second objective is enhance transparency. Ensure that financial statements are clear, complete, and understandable, allowing stakeholders to make informed decisions. Promote accountability. Help companies to accountable to investors and regulators by enforcing standards that reflect economic reality. Improve comparability. Make it easier to compare financial statements of companies from different countries or industries. Attracts foreign investment. By following a global standard, companies can gain investors' confidence, making it easier to attract international capital. Reduce cost of capital. Consistent and reliable financial information can lower the perceived risk for investors, thus reducing the cost of capital. Aid in economic growth. Reliable financial information can lead to better economic decisions by investors, regulators, and governments, helping foster economic development. To develop a single set of high quality, understandable, and enforceable global accounting standards. To promote transparency and comparability in financial statements of company worldwide. To ensure that financial statements provide relevant, reliable, and timely information to investors and other stakeholders. To improve the accountability of companies by reducing the information gap between providers of capital and the people to whom they have entrusted their money. So other objectives of IFRS, it creates a common law. One of its key objectives is to ensure that common law is introduced and adopted by many jurisdictions and countries as possible to bring everyone on the same page. It ensures that everyone follows the same guidelines and adopts a universal way of reporting business activities. Aid analysis, another objective. It helps stakeholder in analyzing a company performance and interpreting the financial position. For example, corporation and government use these standards to make credible financial statements. It helps in categorizing and reporting financial data with accuracy and consistency. Such financial records promote better comprehension and helps decision making. Another objective is it assists in preparation of reliable financial records. By following international financial reporting standards, the data presented in books of accounts are likely to be accurate, reliable, uniform, and appropriate within the bounds of its rules. The high quality of financial records assist investors in making informed economic decisions. Next, ensure comparability, transparency, and flexibility in reporting is another objective. The consistency in reporting accounting practices enables easy comparison of the financial records of compliant companies across nations. Such comparison allow investors to identify risk and opportunities before investing. As a result, it promotes foreign trade and investment also. Next, what are the functions of IFRS? The first one is ensure global consistency in financial reporting. IFRS provides a single set of high quality accounting standards that companies across different countries can follow, promoting comparability of financial statements internationally. Enhance transparency. By setting clear guidelines for the presentation and disclosure of financial information, IFRS helps provide accurate, complete, and honest financial data to stakeholders. Promote accountability. IFRS standards make it easier for investors, regulators, and other users to hold companies accountable for their financial performance and position. Facilitate decision making. Standardized reporting under IFRS provides reliable and relevant information that helps investors, creditors, and others make informed economic decisions. Improve efficiency of capital markets. When companies follow the same reporting standards, it builds investors' confidence, attracts foreign investment, and lowers the cost of capital. Support cross-border business operations. IFRS reduce the need for companies to prepare multiple set of financial statements when operating in different countries, saving cost and efforts. So it assists regulators and tax authorities. The common reporting languages of IFRS makes it easier for regulators to monitor financial activities and for tax authorities to assess corporate taxes. Finally, at the end, we can recall what we discussed in earlier. What is the primary functions of IFRS? To provide uniform, transparent and reliable accounting framework that enhance global comparability, promotes investors' confidence, and facilitate international trade and investments. Yes, students, these are the references books. Please go on through if more informations are required. So thank you very much.